Well, good morning, everyone from Nashville. It's great to have all of you on this webinar. I would like to welcome you all to this third program in our Vanderbilt COVID Commodore Classroom series, Economic Impact in Forecasting in the COVID Era. My name is Eric Cahill. I'm the Associate Dean for Development and Alumni Relations at the Owen School. And I want to thank you for joining us today. We are honored to have as our moderator, Eric Johnson, Ralph Owen Dean, and Bruce D. Henderson Professor of Strategy at Vanderbilt Owen Graduate School of Management, and our distinguished panelists from Owen, Vanderbilt Law School, and the College of Arts and Sciences, as well as Citi. Thank you all. And now I'll turn things over to Dean Johnson to begin our program. Dean?
Welcome, everybody. It's so exciting to be with you here today, and certainly an amazing topic. You know, I always think it's a little bit, crazy in a certain way to talk about forecasting in the middle of a pandemic, let alone any other economic time. But that's what we're going to talk about today, and certainly a topic near and dear to our hearts. You know, we here at Vanderbilt are in the process of reopening the university. It's been a monolithic lift, and we're really excited. At the Owen School, we're welcoming a whole group of students next week, and been working really hard to get ready for that. And sometimes in the middle of all that, you know, we're in the business school, and we love thinking about business and economies, and there's no better time to think about business and economies than right now. I mean, you know, sometimes we can get ourselves all focused on the downsides of what is happening. And of course, there's tremendous tragedy and impact across our communities. And you know, as we face even disproportionate impact in our Black and Brown communities and the issues around that, it's been a horrific summer. And yet, for folks who study and think about this, it's also a time for us to learn together. And when I'll be greeting the students next week, that's one of the things we'll be talking a lot about, is taking advantage of this next year to learn in ways that might never have been possible in a different time. And we're going to do that today because we have really an all-star panel. I was able to get my A-list of folks. Everyone that we asked said yes, and we were just so excited about that. And I think we're going to have a really great conversation. And I'm just going to briefly introduce each of the panelists. Professor Luke Froeb is well known in the Owen community, a long time core micro teacher, and known for his bombastic style and views at times. And we're really excited to have him here. He's the William Oehmig Chair of Free Enterprise, and also has spent a good bit of time in the Antitrust Division of Justice, along with the FTC. Catherine Mann is also been a longtime faculty member in and out of the Owen School over different periods of time, and most recently a member of something we call the Dane Forum, which is those of you who've been around Vanderbilt for a long time will remember Dewey Dane as a federal board governor, and we have a wonderful running seminar series in his name that Professor Parsley now runs, but Catherine is an annual visitor to that. Of course, her day job is the chief economist for Citi, and in that role, directing research across their different platforms, cross-fertilizing macro, fixed income, and equities. And prior to that, she had roles at IMF and elsewhere, so really excited to have Catherine here today. Kathleen McCarran is a newer member to our community, been at Vanderbilt for 2 years, and comes to us with a really great skill set that we're so excited to have on campus. She's a quantitative macroeconomist, and whew, what a time to be a quantitative macroeconomist. Can't beat it. Interested in government policy, you know, right in the heat of what we're talking about here today. And so welcome, Kathleen. And then Rohit Swanee. Rohit is at Harbor Springs Capital, and he's held positions at a number of illustrious investment firms in New York, including Goldman and General Atlantic, and is an alum of Vanderbilt, and has been very involved in the Alumni Association Board of Directors. So we're really excited to have Rohit here today to bring that perspective to the table. And last but not least, Professor Kip Picuzzi. Kip is a distinguished professor of law and economics for the law school graduates. Kip has been really an institution at the law school for a good period of time, and is really well known around his work on pricing lives, which, well, I think we have to think a lot about pricing lives right now in the middle of COVID. And so thinking about the statistical life and how that is used in government policy, how we think about that, how we monetize that. So as I said, an amazing cast of characters. And I think we're going to have some fun today. And I really have asked each of the panelists to give just a brief opening statement. And of course, I had to throw a little bit of raw juice out there to start our discussion. And I asked them, look, we've been in this thing 7 months into the year. A big piece of that COVID has really driven the conversation. And yet when we look at the Dow, well, this morning it's somewhere between 8 and 9% down for the year, and bouncing around like crazy even as we speak. And yet the bigger economy has issues with unemployment and other severe impact that we're seeing. And there's often on people's mind a question about that disconnect between what's happening on Wall Street, or is there a disconnect between what's happening on Wall Street and Main Street, and how they kind of see this playing out. Again, not asking anyone to put hard forecasts out there, but to give some sense of what they're thinking. And so I'm going to give each of the panelists, we'll just run down in alphabetical order, starting with Professor Froeb, about 5 minutes to tell a little bit about themselves and an opening statement about the topic. And I know Luke has brought along a couple pieces of data. He's a data guy. I've never seen Luke give any presentation where he didn't pull out some bit of data somewhere to spark the conversation. So Luke, take it away.
Okay, hey, thank you. I just want to briefly introduce myself by saying that I am a microeconomist, not a macroeconomist, and the difference is that we're wrong about things specifically. And so with that disclaimer, thank you for putting this together. I want to talk about adaptability. And, from my point of view, the future doesn't belong to the strong. The future belongs to the adaptable. And this is an ETF where they go long online, Amazon, all the retailers and who've done well, done well in developing an online presence, and they go short the traditional bricks and mortar. And you see that these changes that it began, 5 years ago, it was trading at about 40, and now it's doubled and accelerated since the lockdown and since the virus kind of made its acceleration. That's going to be a trend, that you're see these trends accelerating. Okay, here is a really interesting story, kind of again with the adaptable. Shopify has garnered 6% of the online market, and largely, and it's accelerating in the last, since the virus came up. What they do is, if you are a traditional retailer, there was a story in the Wall Street Journal this week about Shopify where they had a brewer, a microbrewer in Toronto, had 10,000 gallons of beer, and they had to shut down all their their bars and all their traditional distribution channels. And Shopify, in a matter of days, got the brewer online with an online presence, and was able to sell the beer online, and all the complete supply chain. And they're basically making it very easy to retailers to adapt to the new online. And this is another kind of adaptation that we're seeing. On my block in Nashville, we have 3 new residents from Chicago, and they're young families. They bought houses in the last 6 months. And you see the migration here from the red states are losing people, and the yellow states are moving. And I kind of talk about, there was a Wall Street Journal article about the migration from Chicago to, I think Chicago or Illinois is the big loser. I think Utah is the big winner. And it takes like over a month to reserve a U-Haul to get from Chicago to Utah, because there's no backhauls, so that's an indicator of the relative, movement. And you see people moving from, dense urban environments and which are susceptible to this. You see people adapting, and I think this is a really healthy sign. And then the last thing I want to talk about is really about the relative adaptability of regions. There's no bigger problem where you disrupt people with is innovation. There's nothing as important as innovation. Solow, a great economist, said that a Nobel laureate said that 1/10 of a percentage point in extra growth is going to swamp anything we do. And if you look at the unicorns by region, you see the U.S. and China just smoke the rest of the world, and Europe is really, really underrepresented here. And I think that's indicative of their lack of adaptability. They are going after anybody who's innovative in Europe is going to run into tons of regulation, including antitrust, my specialty, competition regulations that thwart them and slow them down. And so anyway, that's what I got, is the future belongs to the adaptable. And I'm going to stop sharing. Okay.
Thank you, Luke. That was great thoughts. Well, Catherine, you've been on both sides of that Atlantic that Luke's talking about. Welcome. We're really excited to have you here.
Yeah, so I've been with Citi for a couple of years now as chief economist. I was chief economist of the OECD in Paris before that. And I had quite a few jobs before that. I was in academics at Brandeis University. I was at a think tank, Peterson. I was at the Federal Reserve for quite some time, World Bank, President's Council of Economic Advisors, a variety of different things. So, but let's just get going here on where we are with the COVID situation. And if Luke gave us sort of a vision of what it is going to take to get us to the other side of this, I guess I'm going to drag you through the mud of where we are now and what the consequences are of not effectively getting to the other side. So you see 3 panels in front of you. These are the COVID headwinds that are affecting the global economy. I'm going to talk mostly about the global economy because that's my bailiwick. The first one is consumption. Consumption is negatively related to COVID fears. And this one is one where we can see the negative relationship between retail sales on the horizontal and fears of getting COVID, according to a YouGov poll, on the vertical. And so if you're afraid, you're not going to go shopping. And it's one of the few things that keeps people from shopping is being afraid. So the more we have resurgence, a second wave, continued wave, et cetera, that is negative for consumption. And given the role of consumption in driving economic performance around the world, this is a serious problem. The second, of course, in the middle panel is trade. Trade is an important ingredient for growth, particularly of emerging markets, but even for all economies. And deglobalization, a lot of vocabulary about that, but it's in the data already. What you see there is that you've had a dramatic disruption of trade because of supply chain disruptions associated with the asymmetry and who gets COVID, which plant is closed, which plant is open. So that's really very near term. But of course, there was trade already was on the back foot coming from the trade wars between the US and China, and basically the US with everybody over the last year. And there's been a deglobalization push really for about 10 years now, where there's been no change in the standard metrics of trade integration in more than 10 years. So you have contraction, absolute negative growth, contraction in trade, that's the dark blue line, and 2 months looking forward, which is the container throughput index, that's the blue line. You're not seeing any improvement coming soon with regard to trade as being a foundation for growth. The third panel, going over to the right-hand side, is business investment. This is actually the one that concerns me the most, because you see a collapse in business investment. It's different for different countries. It's deeper than it was following the global financial crisis. Now, business is collapsing for a whole host of reasons. Number one, if you are going to be able to open your business, it's going to be according to rules or norms with regard to COVID distancing. And so that means if you're a restaurant, half the tables. If you're a plane, something about the middle seat. If you're in a packing plant, it's more distance. A range of things that are affecting business investment and the lack of desire to engage with business investment because you just don't have the demand. And then, of course, the demand itself is not there. Great uncertainty about demand going forward, evidence of, it's going to be a long slog in terms of getting back to the pre-COVID level of GDP. So nothing there that is going to be supportive of business investment going forward. And of course, if business investment is collapsed, that is going back to the left-hand side of the chart, business investment collapse means that trade is undermined because supply chains are very long for capital investment type of goods. And then, of course, if you don't have business investment, you don't have trade, you don't have employment, and that also is going to affect consumption. So these are three very serious headwinds facing countries in the global economy. So we take that type of background and ask our country economists, we have 64 of them around the world, when do you think your economy is going to return to the pre-COVID level of GDP? Now that's pretty minimal in terms of a target. That's getting back to where you were in January. That's not really a recovery. That's just getting back to where you were. That's treading water. So you've got China coming back, according to our forecasts, coming back soon this quarter. You've got the US, we have a very optimistic US economist believing it's going to come back in the second quarter of next year. Now, you could say this is a half full story because between China and the US, you've basically got close to 50% of global GDP coming back within the next 6 months, soon in the next 6 months. But it could also be a glass half full, half empty. And that's because if you look at everybody else, the Euro area, Japan, the UK, Mexico, this is an extremely long tail of countries that are not expected to achieve the pre-COVID level of GDP for an extended period of time. And I think that, I also have to say, I get to push my country economists when I disagree with them, but ultimately it's their forecast. Both my China forecast and my forecasters and my US forecasters are not going to make their numbers. Let's just say that. So the return to the pre-COVID level of GDP is going to be a long, drawn-out process, which again undermines business investment, undermines trade, and makes it more difficult to retain the previous levels of consumption, which were very supportive of economic performance, both demand and employment. So what does this translate into bottom up versus top down? And there's one more slide after this one. What we do is we put these together and say, what's the trajectory for global GDP in the near term and the longer term? So the trajectory for GDP that we had in place in January was the light blue line. We thought we were going to have synchronized global upturn, 2 3/4, maybe 3% global growth. This was going to be actually a kind of a positive environment. Then, of course, COVID hit, and then we had these different country economists were putting into place their forecasts. So the dark blue dotted line is the country economists, which you say, oh, that's the V-shaped recovery that everybody's talking about. Yes, but there's a pause on that. The first is if you're doing a bottom up, you can kind of shave a little bit on these three different elements that are undermining global performance, consumption concerns, business investment, and trade. If you do a top-down analysis and you incorporate all the spillovers that we're talking about that come from those three dimensions, you end up with the yellow line, which is not a V. It's kind of a swooshy shape. It means that you don't achieve the pre-COVID level of GDP for more than a year, not until 2022. That means companies, on average, are going to see no improvement in their earnings for more than a year. So of course they are slashing everything that they can in order to try to maintain earnings in the face of what is clearly a very difficult situation. Of course, they're also bulking up on debt and issuing new equities. But the other thing to take away from this chart, which I think is really important, is we never achieve the pre-COVID level of the pre-COVID trajectory for global GDP. We never get back to that light blue line. So there's permanent losses to GDP, and we know what happens in those cases because it happened after the global financial crisis. Widening inequality, burdens on the younger people in terms of lower wage growth for their lifetime, and a variety of other issues having to do with productivity. So when you take this to the financial markets, last slide, you take this to the financial markets and you ask the question, okay, if you're a bottom up, so bottom up in the financial markets is taking companies, individual companies, and asking them about prospects for their earnings going forward. If you do that, you get the bottom up consensus on the MSCI World earnings per share, light gray line, and the red dots, which is associated with a prospects for the MSCI World Index on equities. And it looks like it's like, okay, we get back up to previous where we are right now in terms of equity markets. If you take the top down, which is incorporating much more sluggish return to the pre-COVID level of GDP and never getting back to the pre-COVID trajectory for global GDP, you end up with a very different picture for the prospects for equity markets going forward. So are you a bottom up or are you a top down? Bottom up at a micro level does not add up because every single bottom up analyst is saying, I'm going to make my earnings per share by slashing innovation, slashing employment, slashing investment. That doesn't add up because it spills over to all of the other companies. So that's why we have the top down versus the bottom up on the financial markets. And that gives us a lot to talk about.
Awesome. Thank you, Catherine. Certainly, we've got a lot to chew on already, and we'll add a little more. Kathleen, it's hard to imagine a better time to be teaching macroeconomics. You can walk into the classroom any day with the headlines on monetary and fiscal policy or pretty much anything you want, and make a class session out of it. So what are you thinking about these days?
Yeah, so just to, if Professor Froeb gave his disclaimer that he's a microeconomist and claimed that he was wrong specifically, then I suppose I get to claim I get to be wrong much more generally as a macroeconomist. I would love to be able to have some punchline of what's going to happen, but I don't think really anyone truly knows what's going to happen. And what I've been thinking about most is the consumption side. So kind of building on what Catherine was saying, that the consumption and its impact is very big. It's a big part of GDP. And what's going on there, I think, is something really interesting. So I kind of want to look at that. So what I'm showing here is just US personal consumption expenditures from 2002 all the way through the first quarter of 2020. So it's all normalized to 1 in 2002, so you can see growth. You can see we had a drop in consumption through the Great Recession. This gray square is the Great Recession. And we see a drop in Q1 of 2020 of just what Americans are spending. And this amounts to like a 2% drop. What I think is very interesting and what's going to be an important thing going forward is not this picture per se, but what might be hiding when we go to finer levels of aggregation in this picture. So here I'm breaking it up by goods and services. So the red line on top here being goods, the green line being services. If we look at the Great Recession, services kind of propped us up. And you saw this drop in goods demand, but really we saw a continued demand and a flat line here almost for services. Then looking forward to what's going on now, we're almost seeing a flip in the sense that now, at least through the first quarter of 2020, goods demand is fairly constant versus a big drop, around 2.5% drop in demand for services. Well, let's break it down even more. This is just a couple, this is by no means all the goods in the economy, just a few that I've chosen to share. I'm breaking just that goods sector into durables, so your cars, your refrigerators, other appliances, and food. During the Great Recession, we saw a huge drop in durables. We saw food fairly constant, little bit of a drop as people substituted. But in 2020, we're still seeing durables dropping, big drop in durables, food's increasing. People are spending more on food. And this is all in real dollar values. So we're not seeing these similar patterns in goods, and that flat line is really hiding the fact that there's a drop in durables here. There's also a drop in clothing and other things along those lines, but there's an increase in spending on food. So that's one thing that's interesting and different than the Great Recession. Looking at services. Again, I just picked a couple interesting service sectors from my point of view. So this bottom line here, housing. The orange line in the middle is food services and accommodations, so your restaurants, your hotels, and the green line is healthcare. Now I put healthcare on there because it's in the news a lot right now, and we are seeing the interesting effect that the people are talking about, that we saw a big drop in healthcare spending in 2020, actually, mostly due to elective procedures. So that's why that's in there. For healthcare was very constant growth through the Great Recession, big drop right around here. I think I have it as a 4.5% drop in consumption expenditures for healthcare. Huge drop in services for food and accommodations, which makes sense. Now the restaurants are open, no one's traveling. You get this big drop that's really stark in comparison to what we saw in the Great Recession. Housing kind of has that, props up the economy. You can't there's only so much you can change about your housing, especially in a short time. There's only so much you can change how much you're spending. So we're seeing these different patterns than the Great Recession. And why I think that is important is we can think about demand for each of these sectors as creating jobs. And it all follows through with how does this affect the real economy? And these different sectors have different impacts on these jobs. For instance, one I think is interesting is you can break it down by how many jobs are created per $1 million of demand. And there's a lot of heterogeneity in that food services and accommodations, $1 million of demand is creating 16 jobs domestically, versus other sectors in housing or food, you're only getting that $1 million in demand is creating around 5 jobs. So as we see demand levels shift, we're also going to see employment shift. Why this, I believe this is important and interesting is what happens if people change their preferences? Catherine showed a graph about how people were scared to go shopping. What if going forward, we see people not going to restaurants? That's going to have a big impact. And I think even if we get back to GDP in 2022, I think that's going to hide some big differences across sectors. So I guess my main point I want to take away is that there's a lot we can look at in the aggregate. And as a macroeconomist, I love looking at the aggregate, but it is also important to kind of look and see what more is going on. And I think we're seeing some interesting results, and I'm kind of jazzed to see what the data does, and once we start to see the second quarter and other months coming out. So that's what I have.
Thank you, Kathleen. That's excellent. Certainly something on the minds of Nashvillians watching all our restaurants and hotels struggle. Rohit, tell us a little bit from the investor's perspective, your time in private equity and investment banking. Certainly you have the investor's hat on today.
Sure, absolutely. Happy to. I'm just pulling up my slides here. Can everyone see my presentation? Hold on one sec. If not, oh, here we go. Now can everyone see it?
There.
Is it? Okay, great, perfect. So yeah, and just by background, so I come from a background, I started my career at Goldman Sachs and then moved to 2 private equity firms, General Atlantic and Permira. After that, I went to business school at Harvard Business School, and then also left to start, co-found a hedge fund that focuses on public equities. So a lot of my experience comes from the investing world, and actually has a lot of similarities or ties to what has been said so far by all of the really bright people on the phone so far. So I have 5 slides. I'm going to do 1 minute per slide. I'm going to try to go as fast as possible. So the first slide is, what do I think is happening in the world today, given what's going on with COVID? I just want to make sure the slide is visible. Is it viewable?
You're good.
If so, then okay, great. So there's a lot going on in the world today. I'd say, high level, markets are reacting real time. They're going up and down. Interest rates are at 0. Unemployment is through the roof. There's definitely recessions that are already in play and will be happening. Lots of activity is at a standstill, but data consumption is rising. People are at home with nothing to do or with something to do and using Netflix and surfing the net. E-commerce is booming. Companies like Amazon and Shopify are doing extremely well. And the world is becoming a Zoom world. So meetings are ending in person and instead are being done virtually. Now, with respect to what's happening on a sector basis, that's also very important. And the way I see it is there's a handful of sectors that are doing extremely well, and there's a handful that aren't doing so well. The ones that are doing well are some of the obvious ones. So software, internet, the focus on sanitation, hand sanitizers, soap, making sure hospitals and hotels are very clean. Digital payments, people don't want to use cash anymore. E-commerce, you don't want to go to the store. Remote working tools. So many of us are now working from home, so we have to make sure our IT services are up and running from our home laptops. E-learning, medicines, and then virtual healthcare. A lot of folks are not going to the doctor anymore, instead are doing things over the phone. The sectors that are hurting, a lot of these are obvious, but retail, airlines, cruise lines, hotels, restaurants, a lot of this has to do with travel and entertainment, sports, and then even your day-to-day functions, dentists, salons, dry cleaners. You don't need a dry cleaner anymore because you're not going to the office. And so it'll be interesting to see how many of these sectors keep benefiting and how many of these sectors keep hurting. The third slide is regarding how companies are thinking about life. And so these are some of the key questions that I hear a lot of when I speak to CEOs in companies that we're looking to invest in or companies that we are invested in. So one is, I can't forecast. It's virtually impossible. I'm pulling my guidance. I need to cut costs. Are my employees healthy? I need cash flow. Is my capital structure healthy? Will I trip covenants? Will I go bankrupt? Is my IT up to date? No more meetings. The world of handshakes may actually be over. And then, can I engage with my customers even more? I can't visit them now, so can I make sure I can interact with them through Zoom? Is a second wave coming? Do we need office space, commercial real estate? In New York City, for example, if folks don't go back to work, there's a possibility that a lot of companies are going to cut leases. And then how do people stay motivated? When you're at home, do you still have that enthusiasm that you did when you went to the office? Fourth slide is how is the stock market actually reacting to all of this. So what's interesting here is if you take a look, almost all stock markets around the world are down. The only two markets that are up are actually the NASDAQ, which are tech stocks, and China, where coronavirus actually originated. Everything else is down, but what is really impressive here is they're not down a lot. In fact, when you look at the bottom of the market, which was around March 23rd, March 19th, March 23rd, a lot of these indices were down 20, 30%, 40%. But the recovery has been astronomically fast and high. And so why? So if you look at the right side, I think there's a bunch of reasons. Rates are zero. There's a chase for yield. A lot of investors are focused on 2021 now. And then there's also this chasing towards technology stocks. I think someone put a really good chart on showing why technology stocks are doing well. And then there's a shift towards growth. So that's why the NASDAQ's done really well. And there's also a shift to higher quality businesses. That's also why the NASDAQ's done well. Highly recurring revenue software businesses. And then just a couple more slides. What can you do as an investor to navigate the chaos? I won't go through all of these, but at a high level, I just want to point out 3 or 4. One is stop, take a breath, and relax. You know, it's really important to have a clear mind and not get stressed out. Also, not get too worried if you can't figure out what's actually going to happen in the next few months or next year or so. Speak to managements regularly. Talk to them about why they're thinking what they're thinking, how they're dealing with things. Stress test your models. Stress test capital structures. Understand themes. Figure out which themes will benefit and not benefit from COVID. And then the last bullet, number 15, don't also forget to think about the upside. You know what? At the end of all of this, we're probably going to be better off in some sectors. Some companies are actually going to do extremely well. And then my wrap up is a little similar to the slide before, but it's we do need governments in a time like this. Some governments are doing better than others. Medical research, liquidity, funding to people who are out of jobs is really important. As an investor, my biggest recommendation is to don't always follow the herd. Be willing to get into the heat of things. The 2008, 2009 crisis led to some fantastic returns for those who invested. Other countries who have money need to help countries that don't. And then the last thing is, this is not the end of humanity. The point I wanted to make, it's a social point, which is this pandemic has probably absorbed some of the most resources, brain power, and people's efforts in the world in our 100, 200, 300-year history. And so hopefully, as a collective globe, as a collective society, we can actually get through this in a way that is best for all. So I'll stop there. Hopefully that was under 5 minutes.
Perfect, Rowan. No, thank you. It's great to set the table for investors. Well, Professor Akuzzi, I know that you think a lot about some of the issues that were just coming up in the last set of questions that Rowan put on the table, things like the costs related to healthcare. Happy to have your thoughts today.
Thanks to Dee Johnson for putting this great panel together. I have thoughts, but no slides, but I think I have some things to say about the health impacts of COVID-19, which has been my main focus, and the economic analyses that I've seen of the different measures to try and get this under control. I've used my numbers to value the mortality costs of this epidemic. My first point is that the economy is not on automatic pilot. So there's a lot of uncertainty out there, and many of the things that are going to determine our likely success have yet to play out. So the most important is, will we get control of the virus? We're not doing a very good job thus far. Will the stimulus plan pass? What form will it take? And then what stimulus plan do we have after the election when the pressure's off? Will there be another round of stimulus plans? Vaccine, when will we get a vaccine? How effective will it be? I mean, Dr. Fauci thinks 60% is great, but how widely will it be used depending on its efficacy? Then regardless of how all these things turn out, even if they turn out favorably, we're not going to revert to where we would have been had we continued along the lines of the economy in 2019. On the health impact thus far has been huge, and thus far the United States has not performed well. So through early July, The United States accounted for 25% of the deaths, but since we have a higher value of statistical life, we're richer than everybody else. We also account for 41% of the global mortality costs, which is sort of nuts in terms of our share. So you'd like to be doing better than the rest of the world rather than worse. Through July 2nd, we've had a $1.4 trillion mortality cost in the United States versus $3.5 trillion worldwide. In addition, we have morbidity costs, adding another 10 to 40% to these costs. So the health impact thus far has been large. But if you're trying to figure out, is it worth taking precautions? Is it worth trying to decrease this risk? What matters is not really the cost to date, but what cost are you preventing by undertaking additional measures? So it's what are you saving, not what have you already incurred? So lots of times people get the appropriate basis of comparison wrong, saying, well, only 150,000 people have died. But if you didn't do anything, a whole lot more people would be dying. The other thing to think about is, in terms of figuring out whether measures are worthwhile, is that these stimulus plans are almost entirely transfers. So from an economic standpoint, they're not efficiency losses. There are some efficiency effects that may occur if there are work disincentives associated with unemployment compensation. That would be the efficiency loss, but the cost of the transfer itself is not an efficiency loss. But my main punchline from this segment is that the good news is that the worldwide, they have not been hit as badly as the United States. So at least the world markets are likely to recover, which will be good from the standpoint of establishing markets for US goods. Going forward, I think establishing social norms is the key. So all of these actions are really voluntary actions that people take. And I like to commend Vanderbilt, which I think their procedures are exemplary. Vanderbilt is doing an absolutely super job in terms of coming back, and I think coming back safely. And if the rest of the economy would do that, I think the recovery would go a whole lot better. Nationwide, to get people to undertake voluntary actions, what you need is consistent information that recognizes that in a situation of evolving information, I've done a lot of work on risk communication. In situations of evolving information, you have to maintain your credibility. So if you don't maintain your credibility, people are not going to update their beliefs when you tell them something new and you learn something. And I think if you have a strategy of undercutting your public health experts, that's going to generally impede government policies. And I was like struck yesterday by President Trump retweeting a Breitbart video with a doctor claiming that you don't need masks, we have a cure. We have hydroxychloroquine taken in combination with Zithromax and zinc. And Vice President Pence met with these folks, not the lead doctor, but the other members of the group today. And I think if you wanted to try and make progress, we need to start going down the road of having accurate, credible information rather than sort of following all these misdirections. Finally, on the nature of the recovery, I think Kudlow's claim that we're going to have a V-shaped recovery is simply not going to happen. I think the nature of the recoveries can be Catherine Mann's yellow line, her dashed line, her delayed recovery. I think that was like right on target. I think that was great. There's not going to be a sharp reversal. The best that we can hope for is that our economy will be flat for a while if everybody starts being as well behaved as Vanderbilt. And then we'll start to do better, but we're not going to be sort of rocketing up with a V. Vaccine, when it comes, that's also not going to jump us up with a big V. It may only be 60% effective. How are people going to respond? Do we need a booster shot? Will the anti-vaxxers take it? Will I wait for the best vaccine? Maybe I want to wait for the Oxford vaccine to hit the market rather than the Moderna vaccine. In terms of the long run impact, some businesses aren't coming back. And there's going to be a lot of changes, as Kathleen McKiernan noted, there's going to be a change in preferences. Yeah, I discovered that the Kroger tissues are actually pretty good when I couldn't get the name brand. So there's been a lot of consumer experimentation. And I also think there's going to be maybe some migration. I'm in Colorado now. The second home market here is booming. It's been huge. and one of our neighbors showed up infected from Texas. And anyway, but I do think the second home market has done well, but the bike market's been great. So there were questions that came in, where should I invest my money? Bikes. So that's it on my comments. Luke is a great biker, so I thought he'd appreciate that.
Thank you, Kip. Well, I'm going to stay with you for a minute. We have literally hundreds of questions, I think, for this panel. We've hit a lot of them, but I thought one, since you started at opening this up, Kip, a little bit, is this discussion of opening business and what is your mortality cost economics? How does that inform your thinking about maybe a very controversial question of opening back up economies and business?
Well, if you do it safely, it's pretty good. I mean, I get haircuts, for example. So I think that passes the benefit cost test. The benefit to a haircut to me is worth the risk. I use masks, well, and I limit the amount of contact, but I think certainly limited reopening, the kind of thing that Vanderbilt is doing, makes sense. If there were rock concerts, I wouldn't be going to them, or I probably won't go to Vanderbilt basketball games unless they have appropriate spacing for people. But yeah, I think those things, you have to exercise more restraint. So I think you can be selective, but start to do a whole lot of things you used to do.
That's great. Well, another set of questions really had to do with what's in the news this week and all of the excitement in Washington as folks chase each other around the table on this next bit of stimulus. Catherine, how do you think about that? And in particular, one of the questions was how long can we keep a set of small businesses and individuals on life support?
There are a lot of different dimensions of the set of policies, both on the fiscal side and then, of course, the monetary policy side. We've got the Federal Reserve just completing its meeting today. And the way I try to think about it is life support is one way, but another way is to think about it in terms of metaphors is life preservers and treading water. We are absolutely using fiscal tools as well as monetary tools to keep the economy treading water, not advancing, not sinking, treading water, and with life preservers. Unfortunately, what we really need to be doing going forward is to get on active paddle, right? Now, what do you do to make that happen is very important. And I think it's important to distinguish between the European Recovery Fund, which put forward objectives. The money comes later, but the objectives that are set out now is a set of policies to try to enhance digitalization and climate objectives. These are things that are going to require businesses to invest because they are not doing it now. It requires businesses to invest. When businesses have to invest, they have to change what they do. They have to hire people. And there has to be transition. Not every business is going to meet the objectives of climate stringency or digitalization. So not everybody's going to survive. But on the other hand, you do get a situation where you have positive momentum for the business community to be actively investing in real activity, not M&A, not extra equity, not bulking up on your debt so that you can survive. And right now, for in the U.S., that's kind of where we're at. We're still treading water without any objectives going forward that is going to create an environment for business investment, true business investment. And so all of the liquidity spigot, of which we have a lot, coming through the Federal Reserve, lots of different kinds of liquidity, what you're ending up with is that's translating into financial investments. That's part of the reason for the elevation of the equity markets. It's part of the reason why we see very low interest rates and yield curve cap, effectively yield curve control. But none of that is going to translate into, as I say, employment, business investment. And not only is it a demand side story, it's also a supply side story, because of course, we're going to have to repay the obligations. And the only way you repay the obligations, well, I mean, we have choices. We have inflation, we have default, or we grow out of it through productivity enhancement. And so if you set out a strategy that is going to force business to invest, and of course it's tax, it's regulatory, it's spending, it's a package of fiscal efforts, that creates supply side response as well. And we also need that. We also need productivity in order to get us to the other side post-COVID.
I want to jump on what Catherine just said about investment. I think she's talking about the positive side of the coin. That equally important is disinvestment and failing businesses. Businesses that are not coming back. You see that people are adjusting. You know, people are migrating from old, dying, kind of failed blue state cities in the north. They're coming in the south. You're seeing, you know, entire sectors. It's important to let those businesses fail or design policies that don't keep them hanging around for a long time. And I just don't see. Anyway, I don't know enough about Europe, but in this specific recovery bill, but I don't see the kind of the will to let that happen. I mean, to let these businesses die.
What do you think, Catherine?
Yeah, well, it's a definite challenge. I mean, it's hard to have policies of business dying in a crisis when your unemployment rate is 20%, 15%, whatever. But Luke is absolutely right. You do have to let businesses die. You have to get people to move to other businesses to do different jobs, or the same job at a different company. You have to enable that mobility. And not only is it letting the business die and the challenges associated with unemployment, but the other aspect of this that has been very important in Europe is that if you let a business die, then you've got a bad loan on the balance sheet of a bank. And that is also a headwind for recovery. And that is a particular issue now in the United States. And we can see that in terms of the loan loss provisioning at financial institutions, because not only do you have to put on loan loss provisioning for the losses that you see today, but because of the new regulations, it's over the lifetime of the loan. So there's a lot of pretty hefty loan loss provisioning that is part of the sort of the challenge of how banks, what role banks are going to play, or financial institutions in general, are going to play in the recovery process. I think the jury's a little out on that.
Oh, thank you so much, Catherine. Well, Catherine hit one into your court a few minutes ago, talking about the stimulus. And there were a bunch of questions from our audience about inflation. Is there any inflation or deflation in your forecast, Kathleen?
So to preface, I am not a monetary expert by any means, but at least my hunch and my information I've collected talking to other people is that there's much more of a deflationary fear than an inflationary fear, that the high unemployment rates, low demand are going to put more pressure for deflation than inflation, but it's kind of a we'll see, and people are relying a lot on that QE measures in the past have not created the inflation some people were afraid of. So obviously things are different now and there could be different effects, but it does seem to be people are not as afraid of inflation as maybe they could be. Seems like Catherine wants to say something.
I can tell you in my part, of the world, there are definitely a lot of people who are channeling Milton Friedman because they're looking at the balance sheet of the central banks and they're looking at substantial credit growth numbers, M1. Do you remember what that one is? Some people do. And they're looking at gold. And they're saying, these are the signals. These are the signals that inflation is on the horizon. And how should we position ourselves for the inflation that is coming? I'm not in that camp. I'm in the micro foundations of inflation, which is the labor markets, the product markets, exactly what Kathleen was saying, that these are the drivers of inflation today, the drivers of the inflation rate over the last 10 years. But I do think it is interesting that a lot of people remember the inflationary surge of the 70s. I thought that they were all gone, but there are definitely some people in the market who are channeling that, and it'll be interesting to see how they react to some of the inflation numbers coming forward, because right now the financial markets are pricing in very, very low inflation expectations, much lower than even the ones we see in terms of inflation expectation measures from sort of the real side economists and other players in the market.
Awesome. Well, I want to bounce back to Rohit, because you can imagine, Rohit, there were a lot of questions from our audience about investing. And you touched on a number of them in one of your last slides about not panicking and taking a deep breath and so forth. But I guess, what advice would you give investors right now? And then, particularly, I think there's a lot of these folks are coming from the point of view of they've got a retirement account. They're not looking to retire next year or 5 years from now, but they're wondering, should they be moving money around?
Yeah, sure. So I have five major things I'd focus on. One is think long term. So if you think long term, over 20 years, 10 years, 30 years, it's actually really hard to lose money on stocks. And so if you have a long-term horizon, near-term volatility shouldn't bother you. The second thing is think about business quality. In today's world, that's more important than ever. Business quality is, does a CEO own a lot of the company? Is the revenue recurring? Is the business stable even in times of crisis? Is there a real customer value proposition? 3, I would recommend that you develop a sense for what your risk tolerance is and what your return goal is. And so that has a huge impact on what you invest in. But generally, if your risk tolerance is moderate to high, and your goal is to, compound capital at 7 to 10%, maybe if not more, U.S. equities is a great place to be. And within U.S. equities, I'm a big fan of technology. And so it's as simple as owning an ETF called QQQ. It's basically the biggest and best technology companies in the world. Fourth, I would say do a lot of reading. Read a lot. Read the Wall Street Journal, read Barron's, talk to people in the industry, read company transcripts, read filings, 10K filings. The more you read, the more you learn, and the more you actually develop views on what to do. 5, I'd say, is don't be scared to outsource. Investing is hard. I mean, I think it's one of the hardest things to do in the world. And so sometimes there's no pride in finding a great financial advisor or in, speaking to friends and family who have been, successful. Or the last thing is, if you want to keep it really simple, just buy the S&P 500 ETF. Do nothing else. It's barely, very, very, very low fees. It's extremely liquid. And then just close your brokerage account and open it up in 10 years. So all of those things are what I'd recommend. What I would say, though, is it was in my slide. If I go to this slide real quick, this right here, it's stop, take a breath, relax. No one's going to solve COVID. No one's actually going to be able to figure out how long the pain lasts. No one actually knows what's going to happen to the economic fundamentals or the stock market. But if you have a long-term view and you're investing in companies that have good balance sheets that are able to survive downturns, I think you're going to be in great shape.
Awesome. Well, that was a power-packed hour, and we're coming up on 12 noon. And I will say one of the best hours I've spent in the last few weeks. Certainly an amazing panel and a great conversation that we've had. And thank you to all of our friends and alum out there in Vanderbilt Commodore Nation. It's an exciting time for the university, and as Professor Guzzi said, we are opening up ever so cautiously over the next few weeks with lots and lots of provisions in place. But we hope to be able to really create an amazing educational experience for our students during a really unprecedented time. Thank you so much. There is another panel coming up in just a short time. So if you like panels, there's one coming on science, politics, and the pandemic, and that'll be coming up on August 13th.